Legendary investor Warren Buffett is worth close to $110 billion as of early 2023. This massive wealth, however, took years to build. Buffett did not make his first million until he was 32 years old in 1962. More precisely, that year he was worth $1,025,000. However, to make his first billion, it was not until 1990 that this happened, 24 years later when he was 56. After his first billion, Buffett's wealth grew faster and faster. This phenomenon has been observed by many investors, big and small, and over the years it has been closely studied. As early as 1999, Buffett was asked what the secret was behind his success. "Start early," Buffett said. "I started building this little snowball at the top of a very long hill. The trick to having a very long hill is either starting very young or living to be very old. But why start early? The answer is what some have called the eighth wonder of the world: compound interest." A Yahoo Finance article recently wrote a short and sweet article on this in which it stated, "Warren Buffett is one of the biggest proponents of compound interest and was once quoted saying, 'My wealth has come from a combination of living in America, some lucky genes, and compound interest.'" Compound interest is the eighth wonder of the world for investors, but as you can see, it needs to reach a critical mass before people can truly harness it in a normal human lifespan.
When we get chances to deploy the capital, we've always tried to make any entity, whether it was the partnership originally or Berkshire now or Blue Chip Stamps when we owned it or even Diversified Redeemed, we wanted them all to be compounding, in effect, be compounding machines. That's why people gave us capital. That's why we put our own capital in. And if we failed at it, we really felt like we'd failed. It didn't make any difference how much money we made from fees or anything like that. We knew what our yardstick was, and so that will continue.
This approach has been advocated and imitated by other investors. As recent as 2022, asset manager Bailey Gifford sponsored a piece in the British newspaper The Spectator called "Compound Interest: The Snowball Effect." In it, the investor made the following observations. You need to understand how compounding produces exponential returns. It works because you not only earn interest on your original investment, but also on additional returns. Buffett compares it to a snowball going down a slope. The further it travels, the faster it gains size. Compounding isn't the only way to outperform, but it's a way that works. Then it gives two examples. One company was called Watsco, a small Miami-based air conditioning distributor which over the past 10 years it has grown its profits at a compound rate of 12%, never making a loss. As a small player, it had plenty of space to expand in the $17 billion air conditioning sector. This type of combination, strong profit growth and solid expansion opportunities, are the two forces between compounding of money and, as such, for building wealth. The other example given by Bailey Gifford was a far less obscure and much bigger enterprise: Starbucks. The asset manager stressed that even after 2 decades of strong growth, it's still a small enough player in the ever-expanding universe of hot drinks to keep adding stores and menu items. It then projected a 10% annual growth rate. However, here is the trick with finding opportunities that compound their returns. The analysis made by the investor based on past data may never become the reality that one hopes for. In the previous example, Starbucks might not grow at the projected rate. Nevertheless, the principle of compounding interest remains true and a real driver of wealth, and the key is to ensure that one's assessment is as conservative and realistic as possible. One of Buffett's rules for allocating capital is to invest only in what you understand.
We will never buy anything we don't think we understand. And our definition of understanding is thinking that we have a reasonable probability of being able to assess where the business will be in 10 years.
This is how Buffett ensures that his projections are not too wild. Buy attractive assets, the value of which are broadly predictable. Also, Buffett is a long-term buy and hold investor. What this means is that he only sells a stock if the fundamentals of that company have deteriorated to such an extent that the stock no longer justifies its position in the portfolio. Another asset manager, RBC Brewin Dolphin, wrote a piece of thought leadership in 2022, articulating why long-term investing matters. Among the different points it stressed, compounding is extremely powerful when it comes to investing. Albert Einstein described it as the eighth wonder of the world. It is simply earning returns on your returns. For example, somebody earning a nominal return of 5% net of fees in year 1 would see their investments grow by a compounded return of 63% after 10 years. After 20 years, this rises to 165%, and over 25 years, it balloons to 239%. This demonstrates the cumulative effects that compounding has on capital. In other words, buying good investments on just prices and holding them for a long period of time helps compound your wealth. There's an old saying in the investment industry that what matters is not timing the market, but time in the market. Or to put it differently, investors shouldn't try to beat the market on a daily or hourly basis, but to build real wealth over the years. The Harvard Business Review supports this view. In a 2014 paper entitled "Focusing Capital on the Long Term," the authors argued that too many of these major players are not taking a long-term approach in public markets. They are failing to engage with corporate leaders to shape the company's long-range course. They are using short-term investment strategies designed to track closely with benchmark indexes like the MSCI World Index. What is the consequence of this behavior? The paper answers with, the result has been that asset managers with a short-term focus are increasingly setting prices in public markets. They take a narrow view of a stock's value that is unlikely to lead to efficient pricing and collectively leads to herd behavior, excess volatility, and bubbles. This in turn results in corporate boards and management making suboptimal decisions for creating long-term value. In other words, not focusing on the long-term growth of economies and of individuals' wealth. Warren Buffett understood all of this. He saw how markets work and understood the herd behavior dominating big financial centers like Wall Street. He was smart enough to go against them, but he knew that he couldn't just beat the industry by joining in their game. Buffett had to devise a way around the dominating process of allocating capital. Focusing on long-term to compound wealth was that way, that golden ticket to financial freedom. In recent years, his methodology, however, has come under criticism. One Yahoo Finance article stated that made Warren Buffett rich is making us all poorer. The article does not refer directly to Buffett's method as much as to its applicability in the current environment. The crux of the argument is that of course this worked for Buffett, because back then inflation was just under 3% on average per year. But look at inflation now. Imitating Buffett does not work. From the article, over the last century, inflation has averaged 2.87% per year. While most investors would balk at an investment return this low, persistently low inflation flies largely under the radar. Nevertheless, a $100 bill in 1922, with inflation steadily hacking away at its value every year, would be worth only $5.44 today. You would have had 18 times as much purchasing power had you spent that cash 100 years ago. It is less likely to see the death of long-term investing than it is more likely to see a period of transitions for the markets. Long-term investors that want to take advantage of the power of compounding must weather all sorts of environments. Low inflation, low interest rates, high interest rates, and so on. In investing, perhaps it is true that only by waiting for the storm to pass, one can fight it. However, let us know what you think of Buffett's approach in the comment section below. We want to hear from you on what topic we should focus next. If you liked this video, please subscribe, share it, and hit the like button. Thank you for watching, and we'll see you next time.